Besides the rule of never open a trade without also setting a stop loss, even if you plan to sit right there and manually manage the trade, it is my opinion that for you to be a successful trader, you need to nail down this part. I think it is one of the most important in building a strategy. So let's take a look at what you need to have in place to create a high probability entry that you're also going to prove out through back testing and forward testing, of course. For me, the secret golden key looks something like this. In my strategy, as well as in my husband's and son's strategies, there is number one, the baseline or the trade bias. You have that as number one. This, as we just covered, gives the base of if we are on buys or sells. Now, for me personally, in my current strategy that I trade at the time of filming this course, this is determined in my strategy. The baseline is as to if a supply zone is in control or if a demand zone is in control. And depending on which one, in confluence with the overall market structure formation, is my baseline. And I like both to agree. So really, I have two baselines, or you could consider one as a baseline and one as a confluence. But for me, in my strategy, I take my baseline actually has two parts. And one is if a supply or demand zone is in control and the overall market structure formation. And that is my baseline. Which then leads me to the second part, which is the entry signal. The entry signal is going to be what signals you that a possible entry is happening, that you have a valid setup. It doesn't necessarily mean that you are entering a trade just yet. It just means that whatever signal you have set for an entry just got triggered. And then if everything else agrees, you could enter into a trade. But that signal, that's the thing that you've set in place that signals a possible trade entry has to happen, before anything else, before you even start really looking at your confluences. An entry signal could be anything that we have already covered in our trading basics or in any of the tools that I've already mentioned. It could be a bounce off of support or resistance. It could be a touch of a trend line. It could be a moving average indicator or any other popular or obscure indicator. It could be a chart pattern or a candlestick pattern, that occurs at a specific price point. It can be anything. And there is 100% not one right way to do it. There is only profitable and not profitable. For me, in my personal trading strategy, I have marked zones that have several rules that apply before I would even consider it a valid zone, along with several rules in place that refine how I draw the zone and what price points would be considered or included in my range. And when price enters one of these zones, that is my signal to begin watching for an entry. Once your signal has been triggered, you want to have, in my opinion, two additional confluences that agree or make the story of why a trade entry at your point would be a high probability for the trade to continue moving in your direction. Remember that now, if you follow this plan, you will have had a baseline, you will have had an entry signal, and now you would have Confluence 1 and Confluence 2 that all tell you the same thing before an entry ever happens. That is a minimum of 4 reliable tools here that you have tested out that show you that when they are all in agreement, there is a really strong win ratio involved. Confluences can be any of the tools and techniques covered in the Trading Basics unit or any of the tools listed in the market assessment lesson earlier. They can be one of thousands of really cool indicators or just a pattern you see repeated over and over and recognize a high probability of a certain movement after that pattern occurs. As an example, in my personal trading strategy right now, Once a valid zone has been established and price enters that zone, I look for confluences in the form of a requirement of a previous rejection of price at this zone that has not been traded through, as well as a structure shift on my lowest time frame. As in, if price has been pushing up and I'm looking for a rejection at my established zone, I'm waiting on the lowest time frame for price action to break the highest low that was printed and then begin to forming a lower high. I'm also looking for imbalance and manipulation to have happened on either my structure time frame or my entry time frame before entry, which gives confluence to my bias of taking a sell off of a previously established zone. I look for a minimum of 4 confluences for me to consider an entry, and several of my strategies that are the most profitable have even more than that. The next piece of a complete entry plan is looking at volume in the market. As we stated in the tools at the beginning of this section, there are several ways to do this, and that can be done in a way that is as simple as only trading during a high volume time of the market. It can be done through indicators, and there are literally thousands of them on volume, or through other analysis means. But the bottom line is that you need a volume indication on some level to also be at a yes for you to enter a trade. Volume is our trading oxygen. A good volume assessment or a good volume indicator will eliminate many of your losing trades. Use your volume just like a traffic light. Green light go, red light is an absolute no-go. And even a mediocre or bad volume tool or indicator will keep you out of bad trades all the time. I personally typically only trade high volume times, and most often I will even exit my trade before low volume times come. My husband does the exact same, but my son has an indicator strategy that manages his entries. So volume is built into his signals. So it can really be different for every single trader and for every single strategy. And I'm giving you examples of what I'm doing and maybe what my family is doing in their strategy, just to know we're all profitable, but we're not all doing the same thing. And so depending on how you set up, just having all of these pieces in place put you way ahead of what everybody else is building and a lot of what you'll be exposed to in the market. Now, even though this section is on entry rules, I included this last requirement of this exit because you should never enter a trade without already knowing where you are going to exit or having your exit rules fleshed out and in your trading plan. Please, friends, don't trade based on your feelings. Trade based on tried and tested techniques and methods that make you money. Here is a lesson I will keep repeating over and over again, because if you don't do this, you will let trades run longer and place larger size trades when you're on a winning streak, but then you will go smaller when you have had a couple losses. So some of your larger trade sizes will end up being losses, and some of your smaller trades will end up being big wins because you're trading on emotions and you're, already a little gun shy because you just lost a few. Instead, I'm trying to help you create a consistent money tree, consistently profitable, always printing money. Put rules in place and execute. No emotion. Trade, win or lose, and then go on to the next one. You are going to be successful. I just know it. Especially if you take and put in the time, the energy, and the dedication, the work and the hustle to build out your system, to test it and to try it so that you do have that edge in the market. Now, an exit signal is when to get out of your trade, and is just as important, if not more so, as the entry. And that is why it gets its own highlight in the next slide. But just know that every strategy that I teach and ever share and ever develop will always be fully fleshed out with every single one of these parts just in an entry only. You will never find anything on my YouTube or posted anywhere that is only half done. And you need to make sure that anything you trade also has all of these. You can pull strategies off of anywhere and from anyone. And if it is only half done, half developed, no problem. You'll be able now to look at that strategy and tell what is missing and then go and put the missing pieces in for yourself. If you have a strategy, it doesn't have volume, no problem. You can look at here and go, just in the entry only, I can see from this recipe, I'm missing a volume. Or, you know, I've just learned this strategy and what I'm missing is a clear exit strategy, not just when price slows down. You know, so I need to develop a clear exit strategy. And who knows, in you taking and putting these pieces together, you may just discover the diamond trading strategy just by doing that.